I think with Anthropic, that they're just kind of looking for as much detail as they can get about, the kind of revenue model, the momentum behind it. Obviously, we've been hearing data points recently that, we're kind of back end of last year, then maybe the annualized revenue run rate was around the kind of $10 billion market, could be closer to $50 billion by the end of the year. And where they are on that pathway, and what the economics of the business look like. Yes, it's similar to SpaceX. You just kind of live off breadcrumbs, and suddenly you get a big download of data that kind of really helps you to understand the business model more.
Matthew, we characterize OpenAI and Anthropic as being in a race, but is it actually like that? If you have Anthropic going public before OpenAI, does that mean there's less demand for OpenAI's IPO?
Yeah, I think it's definitely right to characterize this as a race, regardless of what the companies might say. That these are huge numbers that companies are raising. I mean, we don't know yet how much either of these companies will look to raise, but if SpaceX is looking to raise 75 billion and Google's out there looking to raise 80 billion, it's going to be in the tens of billions of dollars, and there's only so much capital out there. And so, I think it's definitely better to go earlier than later, because if you go later, you're at risk that either the capital flow has dried up, or that those IPOs that went before you didn't go so well, or the market's taken a bit of a turn, and so you're kind of left, maybe either having to accept a lower valuation or a small amount of money. So I think going sooner is always better than going later when you're raising money.
I'm an old EV to EBITDA guy. Maybe I'll go a little price to free cash flow, but I don't know how you're going to value these AI stories. Do you think the market is going to be valuation sensitive at all, or is it just you take what you get?
I think it's a little bit of both, but I mean, yeah, we what have we got to play with? Nothing really more than EV to sales, and they're pretty eye-watering multiples. Even on that kind of forward multiple at $1 trillion, Anthropic's going to be on about 20 times sales. So, you are having to extrapolate many years out to kind of reconcile that with an EBITDA multiple or an earnings multiple. And there's clearly a huge number of assumptions you're having to put in to get to those kind of forward estimations. So, yeah, it's a kind of a moonshot trade, really, isn't it? That, you're kind of buying into the fact that in some way, shape or form, these companies that are coming to market are going to be the foundational businesses of the next 30, 40, 50 years of technology. And that, it's going to work out eventually for you.
Remember PEG ratios? Yep. And eyeballs and all the different metrics that people used to come up with during the dot-com bubble days. Feels like a total addressable market is a new one for this era.
Correct.
So, Matthew, before we say goodbye to you, as investors get ready to partake in these IPOs, they're likely going to lighten up in some of their exposure to existing tech holdings, because otherwise they have too much concentration risk. What kinds of companies are most at risk then?
Yeah, I mean, it's just a good question, isn't it? I mean, it could be everything from NVIDIA, TSMC. I think you're kind of clearly going to be needing to think about companies where you have had great performance, and that perhaps you're kind of prepared to do a bit of profit taking, maybe taking the view that actually, even if you sell a bit of NVIDIA, intrinsically, you're kind of going to get some benefit and some indirect exposure by kind of playing it through one of these other names. So yeah, it's a tricky one, but I think probably a lot of portfolios are already inherently kind of fairly concentrated. So given the numbers we're talking about, you're going to be having to look at these like mega cap names to kind of trim exposure.